All right. So we are going to look into VIX, synthetic indices. I think I only have 30 or so minutes to do this session with you. So let's just try to be as quick as possible and utilize the little time that we have. So let's start with V. V10, 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 10. One is actually on my trading plan, I always start with V75 one is. Actually, I love that pair for so many reasons. Oh Jesus, we don't have weekly time frame, so let me share my MT5. On V75, usually this is how I do my analysis. I have a trading plan, and these are the pairs which I prefer looking at them in this particular order from V75 one is up to, I don't know, the drifts and whatever. So if I'm gonna do daily analysis, let's say in the morning when I wake up, I start from V75. If I see a potential setup on that day, I'm only going to take a trade from VCN5, or maybe if there are two setups from VCN5 and another pair, I do that. So VCN5 one is what's happening here. If we go to our this thing, all right. How do I minimize this thing? All right, if we go to weekly time frame, you can see like let's look to our left. These are weekly time frame. We have price in this range right here. We can argue that it's consolidating, but on a weekly time frame, just one push might take us like the warrior. For example, when the year began in January, this was our opening, push down, now pushing up. So where is the price most likely going to go? I'm an ICT trader. My primary focus is always on building a narrative. We want to know the context. What's our context? We have drawn liquidity here. That's why I was buying this pair last week. I made a good bucks from this pair because it had perfect price action. We had price trying to push to right liquidity right there, pushing into this fair value gap right there. So now we have price that has reached this fair value gap right there. So liquidity was rated tapping into an order block. I I really don't prefer using order blocks when I'm doing my analysis. They work here and there. Actually, they work if you use them in a proper way, but I don't like trading them. I like using these magnets. Drawn liquidity, order highs, equal highs, previous session highs and lows, fair value gaps. Like those are my PDRs that I use most of the time. But we have price balancing this fair value gap, tapping into this order block right there. So price is struggling to push through. The previous week when it closed, Wicks did the damage, but the bodies are respecting this fair value gap, which is a strong indication of what reversal. right? So this is a strong supply zone. We want to sell from this zone right there. So what are we looking for? We have a fair value gap that has been filled. We have an odd high that has been raided. So we want to see price pushing to the downside. Up to which level? We have this level as our potential TP. We have this level, this low again, even up to this fair value gap right there. But we are not going to hold our trades all the way down. I'll teach you how to take your profits later. But what is important is we want to see price showing signs of weakness from this zone. So if we drop to daily time frame, after price raided these highs, like this one, this is this high, price raided this high, push to the upside. What is price doing? It's failing to push to the upside. But what is it doing? We have this high, which is two candlestick that are lower than it, and it becomes our long-term high. And sorry, it becomes our intermediate term high because it's a swing high being formed inside a fair value gap. So this is our intermediate term high. So this being an intermediate term high, we don't expect price to go beyond this level. But is it time to enter this trade? No. We want to see a clear change in delivery, which is market structure shift or choke, whatever you want to call it, just same thing. So from these lower time frames, right, we have price pushed down, pushed up, down, up, failed to make this high. But what did price do? We have this short-term low. It was broken. Price came into this fair value gap right there and order block. So after this order block right there, we have price that is struggling to push to the upside. But are we going to sell this market yet? No, I wouldn't do that. Why? We have these relatively equal highs right there, which is a strong drawn liquidity. So I wouldn't trade it until I see page of liquidity or on buy side liquidity. Or if we have a situation on H4 whereby this low is being taken out, then we have a pullback and another fair value gap, then I can show this market. So as long as we still have these equal highs that have not been rated and we don't have or market structure shift, I'm not going to enter this trade. So we wait patiently for price to break a short-term low, then we enter our trades. But the most ideal way of approaching this market is to use power of three, whereby one of these we see from these candlesticks. This is low close candlestick. This is high close, low close, high close. If this is going to be a low close, tomorrow, if price comes up and take out this high, I might short this one. But if the price is the next candlestick, like next day candlestick, like tomorrow on Monday, if the daily candlestick closes low and we have price manipulating to the upside, I may take this. Like my entry model is simply power of three. But there are many variations on how you can take it. But considering the fact that these are not for a forex pairs or what do you call this future contracts, we we can't really apply it based on the fact that we want to see a perfect consolidation because we don't have sessions. But maybe if it was a forex pair, I wanted to see how the New York Q zone, how price was going to play out based on the highs and the lows that will be formed from the London session. But we can't do that here. So the perfect way of doing it, we want to have the close of that candlestick, the opening, the close, the high, and the low. Then we determine if we want to go short, want to see price pushing again to the upside, but how are we going to do that? We drop to a 15-minute time frame. From a 15-minute time frame, if we have a fair value gap, suppose, like hypothetically speaking, suppose we have the next three or two candlesticks pushing to the downside, it breaks this low, it starts to expand to the upside again, and we have a fair value gap around this area. So if price starts to move to the upside, expanding to the upside, we want to take into consideration how price would have opened and closed from the H1 and M15 time frame. What do I mean? If the next day candlestick, like the candlestick from the Monday daily candlestick, if it closes around this area and we see price pushing to the upside, this is going to be our manipulation. And we'll definitely enter when market taps into whatever fair value gap that we're going to see from any of these time frame. H4, H1, M15, M5, and so on. So my bias for this pair, this event 5, we are bearish. But we're only going to enter trades based on the conditions which I have just explained. Then let's move to V10 one is. This is actually interesting because I was trading this last week from around here. This is where I entered my trade from here up to around this level. I had a session with some of my students in the morning where I was explaining something to them. Since we have price reacting from this fair value gap, taking out this short-term low, it's an odd low, but it's short-term. Price has been taken out. But if we do the inverse connection of the fib retracements, like from that swing high and this swing low, our entry, it's texting me. Yo. From our entry, like the analysis that we have this swing high, a swing low, and swing high. Our ideal take profit for this swing trading would be around this expansion TP, like according to the rules of ICT trading, if we're using this approach. So if we're going to hold this trade, we have a break of structure that initiated, break of structure that caused this movement. Then what is the order block that is responsible for this break of structure? This is the order block, this one right there, these two candlesticks. These are the two order blocks. Like it's one order block, which is made up of these two candlesticks. So inside this order block, let's turn this to violet. No, let's turn this to gray. All right, let's turn this to Great. So inside this order block, we have two fair value gaps. We have two fair value gaps. We have this fair value gap, this one right there. Let's turn this to blue. Let's turn this to blue. Then we have another fair value gap right there. So the most ideal fair value gap to use is this one. First line of defense, we have our second line, and this rejection candlestick is our last line. So if you want to, so my predictions are, we're going to go lower than this swing low. So as we move down, we want to see a reaction of some sort, a like perfect reversal from 1 to fair value gaps. So as of now, my argument would be, let me delete this one. My argument would be, we are already making an immediate rebalance right there, right? So this is our manipulation. So this movement from the close of our previous week candlestick, movement from here to here, this is manipulation. It's creating a wick like just like this one. Then we're going to see a very strong bearish candlestick pushing price to the downside. So even from today, this moment, I would start looking for shorting opportunities. So I would short this to this level, then I would look for buys once we have a perfect change in delivery here. So if you drop to daily time frame, you can see that we have this fair value gap right there, where price can even like it took out previous day high, we have a fair value gap. So price might actually start reversing right now. If we continue to drop to the lower time frame, we see this supply zone right there. Please mute your mics, guys. Mute your mics. Perfect. So I would short this market. Jesus, this is perfect price. We have break of structure right there. We have buy side liquidity that has been taken out by this strong movement. We have this fair value gap right there. We have this wall order block from this candle, this successive candlesticks. So this would be our order block. Guys, this thing. So we have a fair value gap inside an order block. So this might actually start reversing, pushing to the downside. To do what? Take out this liquidity, sell side, sell side. So the perfect way to enter this trade would be, hey, this is actually good price action. We have break of structure right there. We have a low right there. So if price takes out this sell side, where buy side liquidity has been paged already by this movement. If price takes out this sell side liquidity, like if you see a strong movement to the downside, whatever fair value gap that you are going to see from M5 to M1, you take that entry. Then once you short it, your entry here, your take profit would be around here if you are going to do swing trading. But if not, your first take profit would be this low. Sorry, it would be this low. Sorry, so sorry for that. It would be this low or this low, but ultimately this has to be your first take profit. But always, if you are bearish, your take profit always has to be above a swing low. So maybe few points to the upside, right? So this is what I want to look for. So on V10 one is my bias is bearish. I'm not going to do all the pairs because of our time, but hopefully I hope you all appreciate how you do market analysis, especially if you're an ICT trader like myself. So now let's do current pairs. Which window?